Hey guys, welcome back to another video. Today I'll be talking about mezzanine financing. This is a topic that has recently interested me, being that, I'm going into the investment banking space, and hopefully if you guys do find this video helpful, you can like and subscribe to the channel for more. And if you have any questions, please do comment below. So let's get started. So mezzanine financing is a hybrid of debt and equity financing. Structurally, it is a subordinate in priority of payment to senior debt, but senior in rank to common stock or equity. Mezzanine debt is a highly negotiated instrument between the issuer and investors that is tailored to meet the financing needs of the specific transaction and required investor returns. Now, looking at this illustration, you'll see that from a cost of capital perspective, debt is cheaper than equity, right? The rate of return on equity is 25% plus, whereas with senior debt, it depends on, again, what kind of senior debt you are looking at. So mezzanine debt kind of falls in between the two. So it is more expensive than senior debt, but less expensive than equity. From a leverage perspective, because it's more expensive, it has a higher leverage relative to senior debt, whereas from an equity perspective, it has a lower leverage. Okay. Now, with most mezzanine deals, there are warrants or equity incentives which allow the investor the option to convert the warrant into equity if it is profitable to do so. Typically, specialists in mezzanine investment funds earn their rate of return through two components: current payment and deferred payment. From a current payment perspective, it would account for the cash interest, so the interest that's paid on a year-by-year basis. It would be the principal repayment itself and any royalties that are paid out throughout the year. From a deferred payment perspective, it would be the PIK interest, which is paid in kind. And essentially, PIK paid in kind is, say for example, you pay interest of $500 every year for a respective bond. If it was PIK interest, instead of paying that $500 each year, it would be summed up and repaid with the principal at the end of the bond, at the end of the term. Right now, there's also bonus and exit payments at the end once the mezzanine deal ends, and there's also equity ownership, which is represented through that warrant. Now, for people who might have forgotten what a warrant is, it is a form of an option that is attached to a bond, and so you can really kind of detach the warrant from the bond and trade that separately. But essentially what this means is that the warrant has a certain exercise price for the common stock of that respective company, and if the share price increases above that exercise price, then it is profitable for you to exercise that warrant, acquire X amount of shares, and then sell them in the open market and realize that profit. And so that once again adds another rate of return to the overall mezzanine deal. Okay? So, mezzanine financing is usually completed with little due diligence on the part of the lender and little or no collateral on the part of the borrower. This means that mezzanine financing commands a higher yield than senior debt. In addition, unlike senior debt, there is no principal amortization, which offers flexibility in the short term. And so, principal amortization essentially means when you have a bond, not only are you paying interest on that bond, but you're paying down the principal across the years. Eventually, if it's a straight line kind of amortization schedule, it depends on, the schedule itself, but you're paying both interest and initial principal back. With no principal amortization, and what you can kind of structure in the mezzanine deal is that if you're taking out $10 million, you're only paying the interest on that $10 million for the entire term, and then at the end, you're paying in full the principal. Now, there are trade-offs with that decision. In the short term and in the medium term, while you are paying while you are in that term, it is much cheaper from a cash flow perspective. You're much more flexible. But at the end of that deal, you're going to be screwed if you don't have that money to pay back in full the principal. Right? And so this illustration kind of looks at, the different stages. We have like the senior debt itself. And so we're the prime plus 350 basis points. That's kind of the rates that they're going at. There's also the asset-based and stretch lending, which essentially means there's collateral behind those loans. And then, as you kind of increase in risk and as you increase in rate of return, the gap between this kind of funding gap between senior debt and equity itself is where mezzanine would fall in, right? So it's the preferred stock and common equity return between 25 and 30+%, versus, the rate only subordinate debt, which would return between 12 to 17%. Mezzanine would fall in between. And a common misconception is that people think that mezzanine debt is high yield debt. It is not high yield debt. It is much closer to preferred stock than it is high yield, and we'll talk about that later. Okay, so subordinate debt characteristically has a fixed interest rate or coupon as well as a small equity component, and typical returns range from 10 to 14%. This is much lower than equity investors looking for returns 25% plus. Now, there are multiple ways to structure a deal, but with flexibility, both the company and investment bank can settle on a suitable mixture of current and deferred payment. So talking about those current payments and deferred payments that can be structured in the mezzanine deal, one of the big advantages of this, even though it is more expensive than senior debt, is it comes with a lot more flexibility. And so you're not going to see blue chip companies going and taking on mezzanine debt. The senior lenders are going to be much more comfortable loaning to those blue chip companies than they are to a $5 million market cap small business or micro cap, right? So the smaller businesses who don't have that established credit relationships are the ones that are using mezzanine financing. And when it comes to that, the creditors, the mezzanine investors, realize that they can't be as strict as the senior lenders. They can't be as rigid. So they need to be much more flexible, right? And so looking at the costs, the interest rates, the coupon payments can range between 10 to 14%, right? So that's kind of the internal rate of return on a mezzanine investment. Whereas, as I said before, with equity, it can exceed 25 plus for a lot of private equity shops, okay? So while a mezzanine investment may be more expensive than traditional bank debt, it is not as strict, as I said before. The measurement characteristics are more tolerant. For instance, if the maximum leverage of debt to EBITDA, so debt would be net debt, so it would be debt minus cash and equivalents, and divided by EBITDA, which is earnings before interest, tax, depreciation, amortization. And if the ratio between those two is 3, a mezzanine deal would be closer to 4 or 5. So what that means is that you can increase debt at a higher level, and mezzanine investors will still be comfortable in lending to you. Whereas with senior debt, with the moment you exceed that 3 level, it becomes significantly more risky. And now looking at this illustration, I think it's really interesting. I can spend a lot of time on this because when I was first looking at it, I'm like, God, there are so many comments I can make. But essentially, you have your multiple of EBITDA. So here you have your non-bank debt debit, which is to EBITDA, which is the orange, and then kind of the aqua blue is the bank debt to EBITDA ratio. And as you can see, so the kind of the research I was working off, the average is around 3. So in 1995, 96, 3.3, 3.5. Then in the kind of recessions, so in the, you have the internet crash, the bubble, and as well in 2008, that ratio fell below 3, right? But it's quite interesting to see kind of how non-bank debt has performed. And so through 1995 to about 07, you see this non-bank debt to EBITDA ratio at around the 2 level. But because of low interest rates now, a lot of the times the financing needs for businesses has fallen, or the financing expenses has fallen because of the lower interest rates. And so what happens is that, for the industry itself, for the mezzanine investment industry, you've seen a lot lower volumes because of these lower interest rates. And so that's why you see these ratios are so low. It's not that people are not it's not that they're becoming more and more strict. It's just a matter of people and the demand in the market. Whereas on the other hand, you can see kind of an indicator of the future. You can see kind of in the 2003 to 2007 range, where the leverage, the bank debt to EBITDA ratio went from 2.3 to 5.1. We're kind of seeing that again. From 2008 to about 2013, it's 2.5 to 4.5, and so this constant increase as bank debt to EBITDA leverage continues to increase for these businesses, this can become concerning. But once again, that's due to and fueled to by the lower interest rates. That's a whole different topic. I could talk about that for hours. But long story short, when it comes to mezzanine deals and just in general, and when you're talking about it over the long term, it provides a lot more flexibility, and so the mezzanine investor is much more comfortable in loaning this money to you even at higher leverage ratios. Okay, now mezzanine financing is considered very similar to preferred stock. They both have a fixed coupon as well as an equity component, both of which are less senior than bank debt. The key takeaway is that due to the similarity, when senior debtors analyze a company with mezzanine financing, they see that financing as equity rather than debt. And that's so important. So if I'm a senior lender and I walk in and I'm analyzing your company and you're telling me that, okay, you know what, you already have mezzanine financing. Well, I know that my claims are more senior than that individual. And so if you were to ever run into financial problems, the asset sales, I'd be the first one to be paid off. Right? And so when I look at that, I see your mezzanine financing more as preferred stock, which has to wait for me to be paid off first before you'll get any of the money. And so that's why when there's a combination of the two, when there's a combination of senior and mezzanine financing, you can actually really leverage your company and really increase your return on equity. And so that's like the big advantage. Okay, so to provide an example, if you wanted to buy a business for $20 million and take out a loan for $10 million, that's it. You go to the bank, you want $20 million, you have the other 10 and you want to take out 10 from the bank, you probably will get about 75% of your request. So all of a sudden you end up needing actually $12.5 million in equity. Well, if you fill the gap with a mezzanine deal, say for example you take $5 million from mezzanine investors, the bank, the senior debtor, now sees this $5 million as equity, which provides more credibility. This makes them more comfortable to lend the original ask of $10 million. With $15 million in capital raise, you now only need $5 million to complete the transaction relative to the $12.5 million before, and therefore this increases your return on equity if, of course, all things go well and you do acquire this business and it gives you returns. So you're leveraging yourself by providing this mezzanine financing and confirming to the senior lenders that, hey, you know what? If things go bad, you guys are still going to get this. You guys are still going to get your money first, and so these mezzanine investors are probably going to convert into equity. Okay, so when a mezzanine debt is used in conjunction with senior debt, it reduces the amount of equity required in the business, which reduces overall cost of capital. So recall that equity is more expensive than debt. We talked about that. So, and at the same time, we talked about how it will also boost your return on equity. And so here we have a kind of simple case 1 through 3 illustration of kind of the mixture, and very simplified. Say for example, the green is all equity. So in case 1, we have 100% equity. You going back to that $20 million business, you put up the full $20 million of your own equity. Okay, and so the cost of that equity to you is 35%, right? And so you probably get about 12% back. Now, as you lower your cost of equity, what happens is your return on equity increases. Makes sense, right? If you lower costs on something, then you're probably going to increase the return on that respective thing, right? So in case 2, when we have a mixture of bank debt and equity, now the weighted average cost of capital, WACC, is 19%, whereas return on equity increases to 21%. Now with mezzanine debt, the bank will increase the amount that it will loan you. So instead of making it 50% of the loan, it'll give you 60% while you take out a 20% mezzanine financing and you only use 20% of your own equity. And so what happens is the weighted average cost of capital falls to 11%, the lowest of the 3, while your return on equity is the highest of the 3. And so, really your 5x multiple of equity, and that's really important. Okay? So this is, again, one of the big advantages. And once again, this is if all things go right. And as we know from a historical perspective, that is not always the case. Now, mezzanine debt may serve to substitute for or supplement high-yield financing when markets are unfavorable or inaccessible, especially for smaller companies whose size needs are below high-yield bond market minimum thresholds. So the reason for the funding gap, so we talked about how, there's that gap in between senior debt, unsubordinate debt, and then equity. The reason for that funding gap is due to probably multiple factors, but some of them, and I'll talk to 3. The first one is accounts receivable, inventories, fixed assets are being valued at a discount due to fears. it depends on the company, but I would say more private companies use mezzanine debt more frequently than public companies. And so there is a certain uncertainty when it comes to investors investing in private companies versus public companies where all information is open and transparent, right? And so there is a discount that's placed on that private company and its assets. And so when you're looking at it from a collateral perspective, if they go to the bank and they're like, hey, I want to take out this loan. Oh, well, we need collateral. Well, here, I have this land. Oh, we're going to value it at 60% of what it's worth. You're going to be like, what the heck? No, it's worth that much. It should be that much in collateral. And so that's what the problems they encounter. And so with mezzanine, that's never the case. Once again, there's much little due diligence, and at the same time, they don't really care about that because they earn their rate of return through different means. In addition, with many company balance sheets, there's now significant intangible assets. That goes back to the collateral discussion, but instead of putting up tangible assets, they have nothing to put up because it's all intangible, probably goodwill. Okay, and there are also regulatory limits which influence the loan to value ratio, right? The limit for the respective company or industry. And that's just from a more regulatory perspective. But once again, when you're a microcap company, you will be scrutinized much more than a blue chip company when you do approach a bank. Okay, so that's important to understand. So now, how is it secured? And so I took, even the next slide, I took a screenshots of here. It's the RBC Leveraged Finance group. And I wanted to actually give you really what the banks themselves are communicating to any potential mezzanine buyers or kind of interested parties. And so, the RBC Mezzanine Finance seeks investment opportunities in businesses across a wide range of industries that some or all of the following characteristics. So if RBC based in Canada, and I'd say the key numbers here are sustainable free cash flow with EBITDA typically exceeding $3 million and an enterprise value of greater than $10 million. So EV, you're getting your debt, minority interest, preferred equity minus any cash, right? And so that means essentially like your business has to be worth $10 million and you need to be earning at least $3 million in free cash flow. So just to give you a sense of the minimum, the lower end of the mezzanine investment space for a company like RBC. Okay. Now CIBC, another big Canadian investment bank, and their leveraged finance group. Now here they talk about how revenues need to be in excess of 10 million. So going back to the enterprise value of that means that it's about a price of sales of let's say 1, right? So if you're valuing that business 1 relative to the amount that it earns, then that's kind of it is. So essentially, the industry is in line with that general valuation. Your business is a micro cap. It's not ultra small that it's a mom and pop kind of store and you're at the corner store and you're not going to get mezzanine investments from that. But if you have maybe 2 or 3 stores, then these leveraged finance groups will be interested in what you have to offer. Okay, so to attract mezzanine financing, a company usually demonstrates a track record in the industry with an established reputation and product, a history of profitability, and a viable expansion plan for the business, such as through expansions, acquisitions, or an initial public offering. So considering the leveraged finance homepage for the multinational banks like RBC or CIBC, the key things to focus on are the free cash flow in excess of $3 million, revenues in excess of 10, enterprise value of 10 million plus, and an established track record with experienced management. So your mom and pop convenience store is not going to cut it. You need to have employees, multiple employees, maybe multiple locations if you are a retail, but it becomes much more difficult, especially with the competition that is out there, demanding these types of loans. Okay. So how is mezzanine financing used? Now, the common circumstances in which companies choose the more costly mezzanine financing over cheaper funding alternatives is 1, liquidity for wealth distribution, 2, succession purposes, 3, pursuing acquisitions, 4, funding organic growth. Okay, so I think the 2 big ones that a lot of people don't know about is 1 and 2. Kind of 3 and 4 make sense. Pursuing acquisitions, you just need the money. You can kind of structure, a funding scheme where you take some senior debt and some mezzanine financing, and you combine the 2, and then use that to acquire a business. Not too difficult to understand. For funding organic growth, same thing. You're investing in your business. You're investing organically rather than acquiring a bolt-on acquisition. Okay, so I'll be focusing on 1 and 2. So Number one, liquidity for wealth distribution. Entrepreneurs and family-held businesses often reinvest free cash flow back into their companies over time, and as a result, shareholders find that a majority of their personal wealth is encumbered by the business. Mezzanine financing can be an effective way to fund a one-time dividend, providing liquidity for this past reinvestment and diversifying the owner's holdings. While many senior lenders, even today, are open to lending against collateral to provide for a shareholder dividend, rarely is it without restrictions or personal guarantees. As you can hear, there is a car alarm going off. Excellent. Thank you so much, neighborhood. It stopped. So with regards to liquidity for wealth distribution, essentially what it means is that, like if you have built up this business, you are the co-founder of this business, and you own 60% of this business, and you've invested every single dollar. You've mortgaged your home, and you're paying that off with your salary, and you want to kind of extract a little bit of value as you're heading towards retirement. Well, you can go to the bank and ask for a senior debt, but the problem with that is they're going to need collateral. They realize that the money that they're giving you is not going to be used towards the business, but rather used towards buying out your equity and taking that money and then you buying a Ferrari and having fun with mistresses. So it's not the banks are not comfortable with giving you that money. Once again, mezzanine investors are much more flexible. They realize that as long as the business is free cash flowing and is able to really pay off the respective current and deferred payments, then they are perfectly comfortable in giving you that loan without any collateral. And so that's why it provides a lot of flexibility in that sense. So another challenge, which will continue to become more prevalent as private business owners and partners from the baby boomer era retire, is the sale of their equity position and its transition to new investors or leadership. With larger businesses, the other owners or partners may not have the personal assets to buy him out, so mezzanine financing can be used. By taking out a combination of senior and mezzanine debt, the inactive partner can be bought out. Since it is less dilutive and expensive than equity, the remaining partners increase their original equity stake and leverage their return. So, kind of building off the other one, you don't want to go to the bank and ask them to, we're just going to buy out our partner, because once again, that money is not going to be going towards the business itself. It's going to be going into the pocket of that partner. And so this is a big problem now. I know that being based in Canada, there are a lot of research reports actually released by CIBC talking about how across 5 or 6 years, being in 2017 now, across the next 5 or 6 years, about 30% of mid-market business owners and co-founders are going to retire. And so what happens is, how are they going to monetize those equity stakes? So you might see a lot more mezzanine financing demand in the future. And so this is one of the purposes for that. We talked about acquisition financing. I won't spend a lot of time on the slide. Organic growth, once again, investing in the business instead of acquiring externally. And now the exit. So most mezzanine investments are repaid through cash generated by the business, a change of control sale, or recapitalization of the company. While some mezzanine providers may look to invest in companies that represent strong IPO candidates, most of the time the equity is not converted, so the warrant is not converted. If warrant is exercised, it is common for a company to repurchase any equity issued to a mezzanine investor the moment they get that money back, or the moment that they kind of save up that money, and revert back to its pre-financing equity structure. Right? And so we talked about how with mezzanine financing, you don't want to dilute equity. That's one of the objectives of the company, right? And so if the mezzanine investor is forced to really exercise that to realize their internal rate of return, well then, what the company is going to do is they have to save up more to really buy back that equity. But most of the time you'll see that the mezzanine deals don't see themselves all the way through the term. Majority of the time, the companies use it as intermediate financing until either they get acquired or they acquire a business and they improve free cash flow, and then they take that cash flow and pay down the mezzanine financing deal very quickly. So you don't see a lot of the time it going all the way through the end of the term. So quick overview, the advantages of mezzanine financing. So some advantages are there's no dilution to existing shareholders, which boosts a return on equity. There's no amortizing, the non-amortizing feature and the Pike features offer customized flexibility. The providers, it provides additional sources of liquidity when traditional sources are limited by regulatory requirements, and this therefore is just increased accessibility. There's no collateral needed in most mezzanine deals. It is a cheaper alternative to equity raises, especially for private businesses, so it lowers their weighted average cost of capital, and it is considered equity from a senior debtor's perspective, which provides increased leverage potential, because when they will look at your business, they will see that mezzanine financing as equity, and they will increase the leverage ratio for your business. The disadvantage is it does have a higher yield than senior debt, so it can be costly both in the medium term if you don't choose to go the non-amortization route, and at the same time, if they do decide to exercise the warrants, then you buying that equity back can be costly as well. With the no principal amortization, the principal is paid in full at the end of the term, and if you do choose to take that feature, then as I said at the beginning, that means that you're going to have to pay much more, because all of those interest payments are deferred all the way to the end. And then finally, iBanks offering this type of financing are strict in certain areas. So customer concentration, capital-intensive businesses, a lack of management, commodity-like products or services with low barriers to entry, volatile cash flows. These are all types of risks that will not qualify you for mezzanine financing. So you really need to have a decently strong business for these type of investors to be so flexible with you. Okay? So now I just have two final examples and the video is done. And the first one, it's a simple 1-year mezzanine financing deal. The company is worth $200 million. The mezzanine deal raises $100 million of senior unsubordinate notes with warrants of 10% cash interest. So there's a 10% annual basis, being there's only 1 year. The cash interest for that respective is 10% out of $100 million, which, where's my mouse? Hello. My cash interest, 10% out of $100 million. A cash interest payment of $10 million. There's a PIK, so paid in kind interest of 3%, which is $3 million. That's paid at the end once a principal repayment is also made. So we pay the original $100 million that was invested by the mezzanine investors, plus the PIK interest of $3 million. And then we also have equity value. So we're assuming that in this case, the warrants were exercised, and it represents 4% of the fully diluted ownership of the company. So 4% of 200 million, which is $12 million. And so the total return, so the total cash that they earn at the end, or they receive at the end, is 125 million, which is an internal rate of return of 25%. And so look at that structure. There are 3 different layers. There are 3 different ways. There's a deferred and both. There's current and deferred payments. So the current would be the 10%. And the warrants themselves, and then the deferred would be the PIK itself. And so that, the way it's structured, it can be quite easy for the business to kind of meet the current payments, whereas later on they have to kind of really react and pay the deferred payments. But for the mezzanine investors, if things do go right, they realize an internal rate of return of 25%. Now, a more difficult example, we're considering a 5-year mezzanine financing deal. There's a loan value of $10,000. The maturity, so it matures in 5 years. We're starting in year 0. The interest rate, so the just the general interest rate paid every year is 15%, and there's also a PIK, a paid in kind rate of 3%. Okay, and so I've done the kind of the cash flow statement over here. So starting in year 0, the mezzanine, we're looking at it from the investor's perspective. So we give out that $10,000. And then in the year 1, we earn the interest rate of 15%. And then we subtract the additional 3%. It's PIK. We're deferring that all the way to the end. So we're subtracting 300, the 3% out of 10,000. And we're getting cash flow, mezzanine cash flow in year 1 of $1,223. In year 2, once again, we have interest rate of 15% on the existing balance with the new PIK rate as well. And then we subtract the PIK rate in year 2 of $309, and so we get cash flow of $1,259. And so we go through years 1 through 3 where there is no principal repayment. In year 4, we talked to the business and we decided that, hey, you know what, we're going to be comfortable paying a little bit of the initial principal in year 4. Okay, we make that principal repayment in year 4 of $3,000 of the initial loan value of 10. Plus the interest of $1,439, a PIK of $328, we take that away. So our cash flow to the investors is $4,111. We do make another principal repayment in year 5, a lesser interest rate paid, a lesser PIK rate paid, and then finally on the closing, we pay the remaining balance, the principal repayment. And we get a total cash flow at the close of $8,000, in the last year, at the close of $8,003. And if you calculate these cash flows over the long term, this is a 16.48% internal rate of return. Very strong rate of return. As always, guys, if you did like this video, please comment below and let me know if you have any questions. If you liked it, please like and subscribe to the channel for more, and I'll see you guys soon. Thank you.